Hello, this is Muhammad Samie, and I welcome you all to eAcademe from the platform of CA Educationist. Let's discuss mutual funds. Mutual fund is a pool of funds that is collected from different investors. The funds so collected are managed by the fund management experts or professional money managers who invest these funds in diversified securities like stocks, bonds, etc., and other financial assets. The investors are issued mutual fund units against the investments they make in the mutual fund. These units entitle the investors or unit holders to receive the proportionate share out of the returns that accrue from the investments made by fund managers. This mechanism of collection of funds from investors, issuance of units to them, and subsequently investing those funds into diversified securities matches the financing and investing activity of any publicly traded company. A publicly traded company also raises or collects the equity finance and issues shares to the equity investors. The difference is that a company invests the finance in its own operations instead of investing into diversified securities of other entities. Just as shares represent the proportionate ownership in assets of a company, mutual fund units also represent a proportionate ownership in the investment portfolio of a mutual fund. The investments collected against the mutual funds are invested into hundreds and sometimes thousands of diversified securities, such that if one security suffers a slump, it does not adversely affect the overall portfolio returns because the aggregate fund amount is spread across the securities. The biggest advantage of a mutual fund is that you do not have to worry about your funds as your investment is in the hands of experts and they know where to invest and how much to invest such that the risk and return is optimized. It saves you the time, cost, and pains of personally researching, making investment decisions, and monitoring your investments by yourselves. You can sit back and relax while the fund managers take care of your investments and ensure that the best possible yields are received with minimal risk. Certainly, all this will not be free of cost. All the expenses incurred in management of the funds are deducted from the returns earned from the investment portfolio. Therefore, net returns are distributed to the unit holders in proportion to the units held by them. Therefore, no fees or charges are separately imposed directly on investors. Instead, the investors pay them indirectly. Some of the fund's expenses are transactional in nature, like charges on investor purchases, exchanges, and redemptions, whereas some expenses are recurring in nature that are incurred to manage and operate the fund, including fund management fees, marketing and distribution expenses, brokerage fees, legal and accountants fees, etc. Mutual funds are given the titles according to the asset classes or investment avenues in which the pooled funds are invested by the fund managers. For example, equity funds are the funds that only invest in shares, also known as stocks. As equity investment is highly risky, these funds have the potential to generate high returns. Certainly, the investments are diversified into shares of different companies to optimize the risk management. Likewise, fixed income funds spread the investment in those securities that offer fixed returns. For example, government bonds, corporate bonds, and other debt instruments. Since bonds involve less risk, returns on fixed income funds are also low. Possible fluctuation in the interest rates is the only risk in these funds. Fixed income funds are also known as bond funds. Balanced funds invest into a mixed portfolio of shares and bonds. In a nutshell, there are several other classes of mutual funds depending upon the asset classes held in their portfolio. Mutual fund units are highly liquid and can be bought and sold anytime and with relative ease, which makes them highly liquid investments. Mutual fund units are priced at their net asset value per share, also known as NAV, and can be bought and redeemed back typically at their NAV. NAV is computed by dividing the total value of the securities in the portfolio by the number of mutual fund units outstanding. Fund's NAV does not fluctuate during market hours, but is settled daily at the end of each trading day. In other words, NAV is mainly affected by the changes in value of securities held in a portfolio and changes in units outstanding caused by the purchase and redemption of units. All classes of mutual funds broadly fall into two types. Number one, open-ended fund. Number two, closed-ended fund. In open-ended funds, units are directly offered by the fund company to investors. These funds offer units indefinitely, that is, as long as there is demand for more units. Investors can redeem their units back by selling them again to the fund company. This decreases the number of units outstanding and ultimately impacts the NAV. When we are generally talking about mutual funds, we are actually referring to open-ended mutual funds. Most of the mutual funds are open-ended funds. Closed-ended funds, on the other hand, work just like the publicly traded company. Just like a publicly traded company issues a fixed number of shares through an initial public offer, these units are also issued through an initial public offer and are subsequently traded in the secondary market. Unlike open-ended funds, these can be traded at any time during the day. Since these units are traded in the market, their market price is determined by the supply and demand dynamics. Therefore, their price is usually different from the NAV of the fund itself. Thank you for watching the video. For more videos, keep watching the series of eAcademe from the platform of CA Educationist by Mohammed Samie. For any queries, you may WhatsApp or email at the given contact details.